So joining us now is Rob Koyfman. How you doing, Rob?
I'm doing well. Thanks so much for having me on. This is
That's
really exciting.
all right. Well, listen, we're excited to have you on. We're looking forward to you taking us through some of your charts and stuff that you're finding interesting. But are you joining us for a drink today?
I am. I am. We're at a co-working space in WeWork, and WeWork provides free beers. So I'm lucky enough to have a beer here.
What?
So I know. I can't believe this. You get free beer. We're in the wrong spot, Patrick.
No guff. Like, okay,
Yeah.
so what kind of beer? First of all, are they serving? Is it draft or is it a just bottled beer that they have there?
It's draft. There's a keg on
What?
every floor. So there's five floors here, and
What?
every floor has a keg.
How
Is
sweet
that
is
like
that?
is that a standard like WeWork kind of amenity, or is that specific to New York City WeWorks?
I think it's standard, and I think that was like one of the things that they were known for originally. But what's funny is recently they've had to limit the time frame. They basically lock the keg up until 3 p.m. and they only open it after 3 p.m. because I'm guessing people were drinking it throughout the day. So, uh, which is
That's awesome.
that's how
Uh,
millennials do work now.
that's
Uh,
right. Nothing, and it is a true millennial beer. You're drinking Miller High Life, I guess.
I I am drinking the champagne of beers, Miller High Life. That's right.
It's
well, it's
one
free.
up,
I mean, you can't complain.
one
Yeah.
up from Pabst Blue Ribbon.
Yeah, exactly. And
Okay.
they rotate here, which is pretty cool. So they have different different brewers here,
Oh,
which is pretty
nice.
cool.
Okay, so
All
let's
right.
talk some markets here, Rob. What do you got for us?
Oh man, okay. So I tried to put together a bunch of interesting charts. Kind of try to keep it pretty topical and short. So I think I have like 10 to 12 charts. And a lot of these were created using Koyfin, which is the startup that I started several years ago. And we could go over that later on. But first thing, most important slide, probability of a Fed cut. This is, as you guys know, this is driving all the market action right now in terms of what is the Fed going to do and what are central banks going to do around the world. This is kind of like an interesting way of thinking about the progression of Fed policy over the past 12 months, going from pretty hawkish to pretty dovish, and seeing how the market is pricing future policy. I think one of the most important things is going to be not only the upcoming meeting, and what they're going to say, but I think Jackson Hole is going to be super important because there's a chance, and I think this culmination of speeches over the past 12 months where the Fed members have been discussing ways to measure or better ways to think about inflation and measure inflation. I think there's a chance that Jackson Hole will introduce this new policy where the Fed will say, hey, we should measure inflation over the last 5 years as a trailing average rather than a point by point basis. And that's going to be a super, super dovish action. And Jackson Hole is typically when the Fed releases kind of new policy or releases a new way to think about policy. So Jackson Hole, end of August, I think could be a major catalyst for this market.
So are you in the camp that they're going to cut 25 basis points? That's consensus, or do you think that they're going to be bold and go with a 50 basis point cut?
I think they're going to go 25, just because I think there's no just based on where equities are, and based on the mixed economic data. I think 50 is a little too much just based on the facts, but I think it's going to be 25 and then a policy change or a dovish policy change at the end of August.
But Rob, what you're talking about would actually probably be even more dovish than a 50 basis point cut, in my opinion. Like I agree. I think it's great insight, and I think that a lot of people haven't really put Jackson Hole back on the radar. But as we get closer, it's going to become more and more important. And I agree completely. And I think it's great insight to think that maybe what we're going to see is a change in the Fed's attitude towards inflation, and that might actually drive policy for years to come instead of just in one specific instance.
Yeah, and that's exactly right. And it's sort of thinking about like kind of the duration, kind of equating it to duration. So I think the Jackson Hole move will be a very long duration kind of policy shift. So, my best guess or central scenarios, they cut 25, they shift policy, and then continue to cut after that. But that's, this is obviously a very, very big determinant of what happens to asset prices over the next 1 to 2 years.
Right. So let's talk about why they're cutting in the first place. What do you see in terms of the global economy and the PMIs throughout the world?
Yeah, so put a chart here of kind of the major PMIs: U.S., U.K., China, Germany. They're obviously at a low. What's interesting though is from a trading perspective, when you have PMIs this low, the kind of the prudent thing or the risk reward is for you to kind of look out and say like, what happens when these PMIs rebound? Because obviously asset prices look forward 6 to 12 months. So to kind of like look at the German PMI or the well, China's a little bit different because there's a policy issue going on there. But looking at the U.S. and the U.K., it's saying like, hey, PMIs have come down for the past 12 months. I want to be short growth. That's probably not the right way to think about it. What's I think more interesting from my perspective is to think about where PMIs are at the bottom here, thinking that there could be a policy shift to the dovish side, which would boost growth, and then thinking about how you can what kind of trades or what kind of how assets are going to react to that.
Now, to some extent, equities have already kind of sniffed that out and run ahead, even as bonds have been going up because of the bad economic news. What are you seeing there?
Yeah, so it's interesting. So equities have definitely gone up, but the composition of that or the driver of that rally is interesting because it's definitely not led by the cyclicals. So different ways of thinking about cyclicality. So here I just put a basic one, which is industrials performance versus the SPX. Which is probably kind of like the most direct way to look at cyclical performance, but you could also use some of the commodity sectors like energy and materials. But the industrials sector versus the SPX, so I'm using the XLI here, is actually trading at a 10-year low relative to the index. So that's the middle chart, the green chart. And that's been declining since for the past 12 months. And so even though the index, the S&P 500, is making new highs, industrials versus the market, industrials versus SPX is actually making new lows, and that's in line with what kind of rates are doing with yields. And so when you look at the chart, you could say, "Oh my God, that's so bearish. Growth is negative. Market is making new highs." But what I did was I kind of looked back historically, and you could see here, and I'm sorry, the x-axis should have more definition here, but sort of 2011 to 2013, you had a very similar scenario where cyclicals were underperforming, the yields were coming down, and equities were rallying. And same thing happened 2014 to 2016. And basically, when this happens, you have this dynamic where equities are rallying more based on policy and anticipation of policy rather than what's actually happening in the underlying cyclical data. So I think looking at this chart and saying, I'm going to be short equities just because cyclicals are underperforming, I'm not sure if that's the right way to read it, especially given the fact that you've had two previous episodes with QE1 or QE2 and QE3 here, where a similar dynamic has happened and it didn't signal a bear market that was imminent.
And in fact, when we got a situation where industrials actually started to rally versus the market, you actually saw the market struggle.
Yeah. So that becomes really interesting in terms of like that now becomes a more of a relative call or a sector rotation call rather than a hey, I'm just going to be long equities because you have this underlying churn where maybe some of the more overvalued names in equities that are levered towards rates are actually going to start underperforming, and cyclicals, which are pretty cheap, start outperforming. But net, the market is sort of just grinding barely higher, moving sideways.
Right. So speaking of some over or too expensive sectors of the market, one of those has got to be the utilities. You have a chart here about the utilities versus the S&P. Why don't you walk us through what you're thinking there?
Yeah, so different ways to think about the utility sector. One is from a valuation basis, which we don't have here. But what's interesting, like Matt, it's always interesting to point out divergences because it starts a really fascinating conversation. So here you have this divergence, which I think is pretty interesting, of S&P 500 versus utilities. So this is the relative performance of utilities, but flipped. So when the top chart is going up, the markets outperform utilities. When the top chart is going down, utilities are outperforming. So utilities had been outperforming in 2018 as yields were going down, and they actually stopped outperforming. It's been a sideways trade since the start of the year. And that's happened at the same time as yields have come down. So the yields have come down from 3% to 2%, and utilities have traded sideways. And so my experience with this kind of trade is that the equities are actually tend to be right, or the equities are, all else equal. I would actually say here that I would look for yields to come up, and that the utilities are probably sniffing something out and sniffing something significant out.
Well,
But this is a very interesting divergence for me.
Rob, what I want to ask you is because, like, I understand that utilities have been somewhat underperforming the S&P. I mean, that makes sense what you're showing, but really that's because there was a huge burst in utilities at the start of the year when everyone was piling into these defensive sectors very aggressively. But let's say I put up a chart here on the utilities, just looking at some candle charts here. I mean, this looks like almost like an ascending triangle where we're about to break the 52-week new highs on, let's say, the XLU. And it's hard pressed for me to say that this looks like a bearish chart. And like, yes, there's no doubt that the S&P has actually outperformed. But I mean, what's your feeling? Like, is there still a chance that this isn't over? Like this, that maybe utilities can still go for another leg here, or do you really think this is like a point where those utilities really start to mean revert from this massive rally they had in 2019?
Yeah, I guess it's in the eye of the beholder. So I think
Yeah,
that utilities chart, I'm going to argue, is a double top. I'm just I'm being a little
yeah,
facetious here.
yeah.
So you're absolutely right. So look, utilities are in an uptrend. Rates over the past medium and long term are in a downtrend or yields. And for kind of like me to call the bottom or the top in both
Mm.
related assets there's nothing strong here suggesting that. And I really like your point of the sharp utilities outperformance right into year end. So you see that kind of like in the top chart, right heading into that vertical line. You have this really sharp outperformance of utilities, and maybe now they're just consolidating instead of signaling some kind of turn. So definitely
Yeah,
take your point. But if if we so let's say that my thesis is turns out to be the correct one, and obviously there's probabilities associated with it, and we are at the bottom of this PMI cycle, and the Fed and other central banks get more dovish, then you're probably going to have a re-rating of growth and probably higher yields, at least in the short term.
right, right.
Yeah, yeah. Rob, I like your style. Stick to it. Don't let Patrick tell you about the squiggles and how it's going to go higher. Stick with your
Oh,
short
come on.
bonds.
Rob's a
Short.
squiggles man too, so
I know he
don't give
is.
me that.
Okay, speaking of squiggles, why don't we go to the next chart here? Tech and consumer leading, cyclicals and HC lagging. What are you looking at here?
Yeah, my squiggles are better than your squiggles, right? So so here you have kind of like sector performance, and just to the market as we saw is up 20%, I believe, year to date, which is interesting. It's obviously very high relative to history, but also coming off a bottom, so it's impacted by where you start, which is near the market bottom on December 21st. But regardless, the market equities are doing well year to date. But interesting to kind of think about like what's leading that, and you definitely have this tech consumer leading the market higher, which is important, and kind of important to understand why that's happening. So that's more of a bottom up story in terms of the companies. I'm not sure if that's a macro story, but it's also a factor story in terms of growth versus value, which we'll cover in a second. So you have here tech, consumer discretionary, and consumer services, three sectors which are clearly leading the market. And you have materials, energy, and healthcare. I'd argue kind of healthcare is more of a policy underperformance, and then materials and energy more of a macro underperformance. So that's just kind of laying out what's driving the market return. returns
Right, right.
year to date.
So let's talk about the technology and what's driving that, because I think the next slide here, you talk about Microsoft and Apple being a big component of what we're seeing.
Yeah, so I love looking at this analysis. It's pretty unique analysis that we have in our system, just looking at one command. But it's basically taking an ETF, and so here we're looking at the XLK, and then not only decomposing the constituents, we're decomposing the returns. So when you have an ETF, you have some constituents, you have the weight of each constituent, you have the return of each constituent, and the weight times the return is the attribution. And what's interesting about attribution is it's additive. So when you add up all the attribution, it adds up to the ETF return. So on the top right, you could see there that the ETF, the XOK, is up year to date, is up 30.7%. And then I've boxed in kind of the most interesting observation here, that Microsoft and Apple are responsible for 1,100 bips or 11% of that 30% return. So one third of the tech performance year to date is due to Microsoft and Apple, which is a pretty interesting observation. And again, I think the outperformance there, the performance of Microsoft and Apple, there's some macro to it, but really is a bottom up story or a stock story.
It is worth noting that the two stocks do, like you see it in your middle column there, that they do make up that 36% of the weighting of that. So when you buy the XLK and you put 10,000 in, like literally 3,600 of it is going to just those two stocks. So that obviously is a huge contributor to that, right? But those stocks have definitely been ripping it since. I mean, they did get killed in December, so the year to date performance has a pretty good starting point at the beginning of the year, but definitely.
Yeah.
So Rob, the next thing I can see is that your software can also do subsector of within an index, and walk through. Why don't we go to this next chart and show us, just like you kind of zeroed in on the specific returns within an index, you can of XLK, you can do the same for the broad market as a whole. So what do you have?
Yeah. So here's a scatter plot of subsectors, and what I put together here is an XY scatter plot. On the x-axis, you have your percent return year to date. So how are the subsectors performing year to date? And on the y-axis, up and down, you see how the sectors are performing over the past 3 months. And kind of the value here is to say, well, what's performing well over the medium term, or not well, or what's showing strength and weakness over the medium term, and what's showing strength and weakness over the short term. So let's take gold miners as like an outlier. Gold miners are doing well year to date, but really you could see that they've been outperforming over the past 3 months, over the past kind of short term. And if we look at a candle chart later on of gold miners, we can see that thrust recently of that underperformance. And I've always kind of been interested in things and sectors and stocks and indices that are showing strong momentum and where that momentum is accelerating. And that's definitely an area where momentum is accelerating.
Yeah, so here's the chart on the GDX, but yeah, it's been what a rip just the last 2 days, like from 26 to 20 and a half. What a move, right?
You know what? I hate to interrupt, and
go
Rob,
for it.
We're gonna have to
Let's do it.
Take a little moment out here because Patrick and I have a little bit of a wager going on about GDX, and I don't want to kind of count my chickens before they. I guess what is the saying? Count my what is it like
before they've hatched.
Yeah, there we go. Thanks, Luke. No, but the. Too many beers. But we can go look at the GDX. Patrick, I think that you're having some trouble recently with your gap filling.
Oh, yeah. The gap is not filled. You're right. I think that I might have to owe you. What was there a bet?
Yeah, for sure there was a bet.
But what was it? What was it for?
Yeah, it was a big one. I think it was a steak.
Are you kidding me?
No,
I bet you steak.
Ponied up. Anyways, we shouldn't interrupt Rob. And
sorry.
I made a fool of myself. Forgetting the saying. I knew the saying, but I thought to myself, chickens. What the hell? Chickens don't hatch, right? Because I was thinking about the eggs and stuff like that. I just kind of made a fool of myself. So let's just keep going here. Next slide.
What
factors growth and momentum?
What's the bet?
Oh, it's a steak dinner. That GDX, the gold miner ETF, that upside gap won't fill before the end of the summer.
Well,
Oh,
lucky I'm making a shitload of money on the GDX, so that means that at least it's
Oh
going to pay
yeah.
for your
Well,
dinner.
yeah, that's right. Okay, so let's go next slide. 9 factors: growth and momentum leading. What do you got here?
so interesting way to slice up the market, which is through factors. So we have a dashboard which basically shows factor performance over time, and this is really important to track for several reasons. One is a lot of investments will be quasi or closet factor trades, whether it's sector ETFs or country ETFs or even other macro assets. And then the second thing is it's really really important when factor returns start reversing because that usually shows a shift in the market, some kind of shift taking place. So just important to know and track this stuff. And right now, growth momentum leading the charge. You have when these two factors are going up, that's actually a really a positive thing for risk, bullish. When they start trading sideways and reversing, that's something to watch for on the negative side, and again shows that something is changing.
Yeah, and so if you look there at the 3 bottom ones: value, dividend yield, and small cap.
Yeah.
Traditionally, value kind of factors, and they've been getting smoked. So for all the fundamental guys that are out there trying to buy, small
The
cap
cheap
value
stuff.
stocks, they've been getting absolutely crushed. Now, this next chart, Rob, I must say I'm pretty excited about because I have been talking about value versus growth for a long time, and I've also been talking about the steepener. And you put the two together. Why don't you walk us through what you're thinking?
Yeah, so just two very interesting macro ideas. So one is the yield curve and what that represents, and the other one is value versus growth. And both are very correlated over the past 10 years. They're actually, if you zoom out or you look at the data before the past 10 years, which you can't hear, so let's not do that. But they're not always correlated. So I don't want to commit a chart crime telling you that they're always correlated. But over the past 10 years, they are very correlated, and for good reasons. So if you think about kind of like the yield curve as a signal for growth, that's been declining or waning, and value versus growth as the market's expectations for growth are lowered, the market puts a premium on growth stocks, and that's when value underperforms. The other thing here is more of a sector tilt. So value now is energy, it's financials. Growth is tech. So when the yield curve is declining, growth expectations are lower. Rates or yields are generally going down. That's bad for energy, bad for financials. And on the flip side, that's typically good for growth as investors put a premium on secular growth and high growth industries. So, really interesting. The other, I'll point out the divergence here, though. The yield curve has been sort of flat to trying to come up, and then value versus growth has continued to decline. And that's kind of a very interesting dynamic to think about. And if the yield curve can continue to steepen, if we do have this policy shift, the yield curve steepens, that's a really interesting trade to look out for, and could mean a big reversal and a great opportunity in the short term for a tactical trade.
Yeah, so it's actually kind of counterintuitive. The fact that there's been so little growth in the economy means that investors overpay for the few growth stocks that there actually are, and leads to the growth stocks outperforming the value stocks. And it's just kind of, I think you explained it really well by your explanation. Now, I must admit, I love this trade, and I know it's also because I love the steepener trade. But I think this value versus growth, we are in kind of that period that we saw also at kind of 99, I believe it was, when Julian Robertson tapped out. He said, "That's it. I can't take it anymore. I don't understand the market." And he was a famous value kind of investor, and that proved to be the bottom on the value versus growth trade. And I think we're very close. Now, I realize that to some extent I've lost the privilege of calling this bottom because I've called it so many times. But I'm hopeful that if maybe both my trades will work, the yield curve and the value versus growth at the same time. So I think this is a great chart, and thanks for pointing that out, Rob. So let's
Cool.
look to this next thing: cross asset valuation, emerging market bonds.
Yeah, so looking at this is a chart I stole. I believe this is from BAML, but basically looking at cross asset valuations relative to the past 10 years. The red X is where it is in the distribution, and you look at kind of like everywhere, equities, rates, credit, everything's expensive, particularly in rates relative to the past 10 years. The one sector which kind of looks okay or looks more on the cheaper side is emerging market credit. And so the one kind of trade idea, I don't know if I'm allowed to pitch a trade idea, but
Oh, sure.
emerging
Go ahead. You go ahead.
emerging market bonds are look really good here. I think they do well in a bunch of scenarios. So if yields continue to collapse, as long as there's no systematic risk, they do well. I think if growth rebounds and there's some emerging markets outperformance, they can benefit as well. But the way to play that is kind of the next slide, EMB ETF. So I have it here, which is the easiest way to play it. And I have the ETF here versus flows. Flows are sort of up and down over the past several years. I'd say June was a pretty strong month. You saw some flows into the index. Past couple of weeks have been weak, but I think this is a chart and a ETF to watch.
Yeah, that's a great call. Now, Rob, when we're sitting here staring at all your charts, I must say that they are mighty impressive and mighty beautiful to look at. Why don't you tell us a little bit about your company, Koyfman, because these were all created on Koyfman. And I've long kind of pointed people towards this product when they want a free kind of macro, not quite a Bloomberg, but yet again doesn't have the $20,000 a year price tag. So why don't you walk us through what it is, how you got started in it, and what you can find on it?
Yeah, so I was on Wall Street for a long time as an analyst, as a strategist, as a trader, and I was always kind of using a Bloomberg and FactSet and all the other tools out there. And I was at a hedge fund in my last job in 2016. The hedge fund wasn't doing that well. I left to trade on my own to try and put out some research. Similar to what you guys do with your newsletters and your ideas. So that's what I wanted to do 4 years ago, just to keep my ideas fresh. And when I needed to kind of put the resources together and to pay for my own resources, I started to really understand the market out there for these sort of resources. And what I quickly found was that if you don't have a Bloomberg, there's no real good alternative out there. And so I started thinking about why is there no data provider, no analytics platform that gives you macro functionality, equity functionality, but doesn't cost $25,000 a year. Furthermore, Bloombergs are super powerful, but they're very difficult to use. They're not very accessible. They were designed 30 years ago, and that design never really changed. So I thought there was an opportunity to create a lighter weight, more intuitive platform for people to use. So that's why I started Koyfman. We basically we three main things we provide in terms of our value proposition. Number one, super intuitive and user friendly, and that includes being free for now. You could go on our website, just start using it. So that's value prop number one. Value prop number two is we centralize a lot of interesting data. So not only equity data, fundamentals, but also economics, FX, commodities, anything that you would want to, anything that your average investor would want to look at, we bring into one place, and we can go through some examples in a second. And the third thing is not only are we providing the data, we want to provide the tools, the dashboarding tools, the graphing tools, the screening tools to actually analyze that data and to make sense of that data. So that's the three things we do. We launched, we haven't been around for that long, but we've had very strong user growth, really good feedback. And thank you again, both of you, for pitching us and pointing your followers to our product.
Well, Rob,
It's
I'll
really
tell
helpful.
when I was introduced to your product, Kevin actually originally brought it to my attention, and then I got in touch with you through some of my members. And I have to say that once I learned about your product, I've been using it quite a bit. Unlike Kevin, I don't actually have a Bloomberg machine, and often I turn to your website to get some amazing analytics. So I'm a big fan, and that's why I was happy to have you on the show. So my endorsement for sure. Anyway, why don't you?
Sorry, I didn't mean to interrupt, Patrick. Why don't you just kind of throw us give us kind of two different or three different features that you want us to just highlight very quickly?
Yeah. So if I can, if we could, I'll just kind of like speak to the layout of the system. So on the left-hand side is where you kind of like could click through the menus. So right now you're on today's markets. That's highlighted in
Yeah.
blue. So that's like your main markets page in terms of what's going on. Whenever you're on these dashboards, you could actually click off. So those little boxes, color boxes, right to the right of where your mouse is. Oops, to the right.
Oh,
Yeah, exactly. So you could click on those boxes, and that's going to basically impact the chart. So that's like your markets dashboard where you could view different things on the chart right there. And then if you continue to click on markets, the blue, yep, open that up exactly. So then you have your top news as your next thing, your which is obviously what's going on in the market, world equity indices. So this is where we slice and dice different parts of the market. So these are your world equity indices. Next is your country ETFs. You can see the performance there. Next is your sector ETFs, and then the last thing in markets is that factor analysis that I mentioned to look at
yeah.
factors. Um, equities. You macro guys probably don't care about equities, so we could skip that. Uh, not very important. Fixed income, we have all the global yields out there, so you can actually like see all the yields and again benchmark them and see browse by country and see what's going on there. So really easy to do that.
And
Okay.
Rob, I'll have to. I'm going to give a quick plug here because if you go under the corporate credit, a lot of people have a hard time digging up, looking at what's going on in the triple Bs and the and junk bonds and looking at credit spreads and all these different things. And you could find it all right here. It's actually really neat. That's one of my favorite things to watch for as well on this chart. So you can
Yeah.
find it all on here. Great stuff.
So I think everybody should just go if you're at all interested. Go. It's free. There's no credit card you have to give in advance. It's not like there's some sort of trick. I guess eventually you're going to want to get paid, but that's still a little ways away, and you're not talking about that. So in the meantime, everyone should go sign up and use the resource because it's a terrific resource. So Rob, why don't they tell you? Why don't you tell us kind of where they can find you and the product, and walk us through the best places to reach you?
Yeah, so the product, just go to our website, koyfin.com, Koyfin. And again, it's a web-based product, so you can just go on the website and start using it. Um, uh, just as a, FYI, you mentioned pricing. Our vision is we're always going to have a free product. So whatever you use now, it's not like we're going to lock up next week or next month. So we're always going to have a free version. And then at probably towards the end of the year, we'll have a premium version, which will include more customization, more data, more access, and stuff like that. But the free product will always be there if you don't feel like paying for it. And then we're also on Twitter, Koyfin Charts, or you could shoot me an email, rob@koyfin.com.
Great. Well, thanks for being with us.
Glad to be here.
Oh,